Hi everyone, today we'll be going over accounts, May-June 2022, paper 2-1, question number 4. This is structured paper 2, which consists 4 questions, 2 of 30 marks and 2 of 15 marks, and we are also given a time limit of 1 hour 30 minutes. And since question number 4 is of 30 marks, we will be attempting to solve this question under 30 minutes. So without any further delay, let's get started. N Limited manufactures a single product at one of its factories, and the company uses marginal costing. Now, for the first part of this question, we need to state 2 benefits of using break-even analysis. So, break-even analysis identifies a point at which a business will make a profit, right? So, that is a major benefit. Let's write it down. Identifies point at which a business will make a profit. And then the second advantage would be that it helps in understanding the risk involved in a proposed manufacture, right? So we can easily figure out the break-even point, which means that this gives the number of units that we have to sell in order to reach to a profit-making point. So if that particular unit is pretty high, then we can say that that product would be quite risky because we do not know whether the customer would be willing to buy such high numbers, right? So this helps in understanding that concept as well. Let's write it down. Aids understanding of risk involved in a proposed manufacturing venture. This concludes the first part of this question. Now we can move towards the second one. We need to define the term fixed costs. So fixed costs are those costs which do not change with the change in level of outputs or sales. Let's write it down. Fixed costs are those costs which do not change with the change in level of outputs or units sold, which we can write down as sales. Now this concludes the second part of this question. We can move towards the third one. We are given additional information. The following details are available for 1 month's production. We are given the fixed cost, break-even point, selling price per unit, and margin of safety. Now for the third part of this question, we need to calculate the variable cost per unit. Okay, so we need to figure out our variable cost incorporating these values. So we can see that we're given break-even point, right? So we will be utilizing the formula for break-even point in order to figure out our variable cost. So we know that break-even point is just the fixed cost divided by contribution per unit, right? And we are told that the break-even point is 8,000 units. So that's 8,000 equals to, and we are told that the fixed cost is 70,000. So that's 70,000. And we know that the contribution per unit is just the sales price minus the variable cost, right? And we are given the selling price per unit to be 20. So we can just write our contribution as 20 minus variable cost, right? So now this is a very simple equation through which we can figure out our variable cost. Let's solve this. So we just multiply this denominator to the other side. That's going to be 8,000 times 20 minus variable cost equals to 70,000. So that's 8,000 times 20, which results in the value of 160,000, minus 8,000 times variable cost. So that's 8,000 times variable cost equals to 70,000. So we can just bring this value to this side and this to the other side. That's going to be 160,000 minus 70,000 equals to 8,000 times variable cost. And 160,000 minus 70,000 would be 90,000 equals to 8,000 times variable cost, which gives our variable cost to be 90,000 divided by 8,000, which results in our variable cost per unit to have the value of 11 0.25 per unit. All right, this concludes the third part of this question. Now we can move towards the fourth one. We are again given additional information. The directors have decided to increase output by 20%. All right, let's have a look above. We are only given the fixed cost, break-even point, selling price, and the margin of safety in dollars. So we can figure out our total output by utilizing our margin of safety, right? So we can say that margin of safety in dollars would just be the total output minus break-even point times selling price per unit. And we are given that the margin of safety is 80,000. Let's substitute this. And we need to figure out the total output minus, we are given that the break-even point is 8,000. So that's 8,000. And we also know that our selling price per unit is 20. So we're just going to substitute this value as well. All right, so that is just going to be 80,000 divided by 20 equals to total output minus 8,000. So let's bring this 8,000 to the other side. So that's 80,000 divided by 20, right? Which is 4,000. So that's 4,000. This comes to this side, that's going to be plus 8,000 equals to total output. So the total output in this case will be 4,000 plus 8,000, which results in 12,000. So this is the total output, and now we are trying to increase it by 20%. So let's figure out the total output in this case. So we have our previous total output of 12,000, and now we have to increase it by 20%. So that's just 1. Since we are increasing, we need to add the 20%, which we can write down as 0.20. So that's 12,000 times 1.20, which results in our new total output to be 14,400. And then we're told that new machinery will be purchased at the cost of 72,000, and the new machinery will have a useful life of 5 years, which means that this cost should be distributed among 5 years as depreciation charge. So let's figure out the depreciation per year. That is just going to be the cost of 72,000 divided among 5 years, which gives the depreciation for each year to have the value of 14,400. All right. Then we are told that the variable cost will remain unchanged. So whatever variable cost per unit that we figured out above, that's going to remain the same. Let's have a look above. We figured it out to be 11.25. So let's substitute this value. Then we are told that the selling prices will be reduced by 5% to ensure that all production can be sold. So let's figure out the selling price. We will start with our previous selling price per unit, which is 20. Let's write it down. So that's 20 times 1, and since we're reducing it, that would be a minus, and we're reducing it by 5%, which you can write down as 0.05. So that's just 20 times 0.95, which results in the new selling price to have the value of 19. And for the last part, we're told that the cost of new machinery will be financed by the issue of 10% debentures, which means that we will be issuing 72,000 as a 10% debenture, which means that there will be interest on debenture as well, right? So let's figure out the total interest charge. So that is just going to be the value of the debenture, which is 72,000 times 10%, which you can write down as 0.10. And this gives the total interest on debenture per annum to be 72,000 times 0.10, which results in 7,200. Alright, now for the first part of the fourth question, we need to calculate the monthly revenue based on this plan. And we know that the monthly revenue is just the total output multiplied by the selling price per unit. And we've already figured out the total output as well as the selling price per unit, so we just have to substitute those values. We can see that we figured out the total monthly output to be 14,400, and we figured out our selling price per unit to be 19. So this gives the monthly revenue based on this plan to be 14,400 times 19, which results in the value of 273,600. Alright, now for the second part of fourth question, we need to prepare a budgeted marginal costing statement for 1 month based on this plan for total production. Okay, so we will be starting with our revenue. And we already figured out the monthly revenue to be 273,600. Let's substitute that value. Now we subtract the variable costs. Okay, let's have a look above. We can see that the variable cost per unit still remains at 11.25. So let's figure out the total variable cost. That is just going to be the total monthly output times the variable cost per unit. So we have our total monthly output to be 14,400. And we just need to multiply it with our variable cost per unit, which is 11.25. And this gives the total variable cost to be 14,400 times 11.25, which results in the value of 162,000. Let's substitute this value into our statement. So that's 162,000. And when we subtract the variable cost from revenue, we get our contribution. And in this case, the contribution is going to be 273,600 minus 162,000, which results in the value of 111,600. Now, after contribution, we need to subtract the fixed costs. Let's have a look above. We have not figured out our fixed cost per month, so let's figure that out. We will be starting with our original fixed cost per month, which amounted to 70,000. Let's write it down. So that's 70,000. And we know that we also have our depreciation for new machinery, right? And we figured out the total depreciation for 12 months. Let's figure out the depreciation per month. So if this value is of 12 months, then for 1 month, that is just going to be 14,400 divided by 12, which results in the value of 1,200. Let's add this to the fixed cost. So that's plus 1,200. And remember that we also issued 10% debentures, which means that we have interest on debenture, which is a fixed cost again. And we already figured out the per annum charge. Let's figure out the interest per month. So if this is the interest for 12 months, then for 1 month, that is just going to be 7,200 divided by 12, which results in the per month interest charge on debenture to be 600. Let's add this to the fixed cost. Now this gives the total fixed cost per month under this particular plan to be 70,000 plus 1,200 plus 600, which results in the value of 71,800. Let's write this in our statement. That is 71,800, and we need to subtract this. Now, after subtracting the fixed cost from our contribution, we get the profit for the month. And in this case, that's going to be 111,600 minus 71,800, which results in the value of 39,800. And this concludes our budgeted marginal costing statement as well as the fourth part of this question. Now we can move towards the fifth one. We are given additional information. At another factory, the company manufactures two products, X and Y. Both products use the same material. And we're given the following information: the selling price per unit, direct material per unit, direct labor per unit, and the total output. And we're told that this factory's fixed costs are 58,000 per month. And in April 2022, the supplier of direct materials informed the company that it would only be able to supply 75% of the normal monthly requirement in June 2022. Okay, now for the fifth part of this question, we need to prepare a budgeted production plan for June 2022 to show the maximum profit available. Since we will only be getting 75% of the normal monthly requirement for direct materials, we need to allocate this particular direct materials to products X and Y based on their contribution to direct materials ratio. So let's figure that out first. We have product X and product Y. So first of all, we require the contribution per unit. Now we are given the information regarding selling price and our variable cost, which is the direct material and direct labor. So we can easily figure out the contribution right here. So that's contribution per unit. And that is just going to be selling price minus direct material minus direct labor. For product X, that's 32 minus 10 minus 12, which results in the value of 10. And for product Y, that's going to be 44 minus 14 minus 19, which results in the value of 11. So let's write it down. That's 10 and 11. And now we require the contribution per direct materials ratio. So that's contribution per direct materials, because our scarce resource is direct material in this case. So for product X, we already figured out the contribution, which is 10. So the contribution per direct material ratio would be 10 divided by the direct material per unit of 10. So this gives the ratio to have the value of 1, right? Let's write it down. And for product Y, we have the contribution of 11, and we need to divide it with the direct material per unit of 14. So in this case, the ratio will have the value of 11 divided by 14, which is 0.79. Let's write it down. So now we need to rank these products in the order of their priority. And whichever product has the higher contribution per direct material ratio will be prioritized first. So in this case, we can see that 1 is definitely greater than 0.79. So product X will be prioritized first, and then we move towards product Y. Okay, this just means that we need to fully produce product X, and then we need to utilize the remaining direct materials in order to produce the viable outputs for product Y. So now we need to figure out the total materials available, or direct materials. Okay, let's figure it out for product X and product Y. We are told that for product X, we will be producing 5,000 units, right? So in order to figure out the total direct material cost, we just need to multiply the number of units to the direct material per unit. So that's 10 times 5,000. Let's write it down. 10 times 5,000, which gives the materials available to have the value of 50,000. We repeat the same process for product Y. That's going to be the direct material per unit of 14 times the total output of 4,000. Let's write it down. That's 14 times 4,000, which results in the direct material for product Y to be 56,000. Okay, so the total materials available is just going to be the sum of these two values. So that's 50,000 plus 56,000, which results in the value of 106,000. Okay, and now we were told that the direct materials supplier informed the company that it would only be able to supply 75% of the monthly requirement. And if this is our normal requirement, then 75% of 106,000 is just going to be 0.75 times 106,000, which gives our new direct materials available to have the value of 79,500. So we need to allocate this value of direct materials to product X and product Y based on our priority. And like I said before, we are prioritizing product X, which means that we need to fully produce product X. So previously we had been producing 5,000 units of product X. So let's allocate that particular materials. So now the allocation. So product X will be getting what they usually got, that is 50,000, right? Then the remaining materials would be 79,500, which is our total, minus 50,000. So this gives the remaining direct materials to have the value of 29,500. Okay, now let's have a look at the question again. We need to prepare a budgeted production plan for June 2022 to show the maximum profit available. Okay. So in order to figure that out, we first need to figure out the number of units that we will be producing for both product X as well as product Y. So for product X, as we can see, we are fully providing all of the direct materials, which means that the number of units for product X is still going to remain at 5,000, right? But for product Y, we are only investing the direct materials of 29,500, right? And we can see that the direct material per unit is 14. So we can easily figure out our number of units, right? So I'm just going to explain the formula right here. So direct materials per unit is just the total direct material cost divided by the number of units, right? So right now we are figuring out our number of units. So number of units is just the total direct material divided by direct material per unit. So we will be utilizing this formula. Let's do that. So we have the total direct material available of 29,500. And we are told that the direct material per unit for product Y is 14. So we're just dividing it. So this gives the total number of units for product Y to be 29,500 divided by 14, which is 2,107.14. Since we're talking about units, we need to round it off. So that's 2,107 units. So now we need to figure out our budgeted profit, right? So we need to create some sort of statement. So I will be starting with our contribution, because we already know the contribution per unit for product X as well as product Y. So contribution per unit for product X was 10 and for unit Y it was 11. So let's figure out the total contribution. In this case, that's going to be 10 times the number of units for product X, which is 5,000, plus contribution per unit of 11 for product Y times the number of units for product Y, which is 2,107. And this gives the total contribution to be 10 times 5,000 plus 11 times 2,107, which results in the value of 73,177. And now we just need to subtract all of our fixed costs in order to figure out the budgeted profit. And we were told that the factory's fixed costs are 58,000, so let's subtract it. That's 58,000, which gives our budgeted profit to be 73,177 minus 58,000, which results in the value of 15,177. And this concludes the fifth part of this question. Now we can move towards the sixth one. We are given additional information. A director has suggested an alternative plan that the factory should produce extra units in May 2022 to make up for the shortfall of either product X or product Y in June 2022. Any additional production will require overtime to be worked, and we are given following information. All materials requirements can be met in May 2022, but the material has to be converted into finished product immediately as purchased. Overtime is paid at 1.5 times the normal rate, and the extra units will be stored at the cost of 4,000. And for the sixth part of this question, we need to calculate the profit or loss to be made on the extra units if this plan is implemented in May 2022. So we only need to figure out the profit or loss on the extra units. Okay, we know that in June 2022, we can fully produce all of the units for product X, but we can only produce 2,107 units for product Y, right? So let's figure out the remaining units to be produced. So that's remaining units, and the total units for product Y was actually 4,000. So the remaining units would be 4,000 minus 2,107, which gives the number of units to be produced in May 2022 to be 1,893. So now we need to figure out the profit or loss made on producing these extra units. Okay, so first of all, let's figure out our contribution per unit. Okay, let's have a look at product Y's information. So we have the selling price per unit of 44, direct material per unit of 14, and direct labor per unit of 19. But we know that this would require overtime, and overtime is paid at 1.5 times the normal rate. So that is just going to be 44 minus 14 minus 19, and we're paying overtime, so that's times 1.5, which gives our new contribution per unit to be 44 minus 14 minus 19 times 1.5, which is 1.50. So now we can easily figure out the profit, right? So now in order to figure out the profit, I'm just going to create a statement. So we'll be starting with our contribution or the total contribution. So that's just the total number of extra units, 1,893 times the contribution per unit, which is 1.50, which gives our total contribution in this case to be 2,839.5. And we need to subtract the fixed costs. And we can see that our storage cost is a fixed cost, so we need to subtract this 4,000. So we can clearly see that the fixed cost is greater than contribution, which will result in a loss. So the loss in this case is 2,839.5 minus 4,000, which results in the value of 1,160.5. Alright, this concludes the sixth part of this question. Now we can move towards the seventh one. We now need to advise the directors whether they should use the original budgeted production plan in E, or whether they should increase production in May 2022 as suggested by the director in his alternative plan. We need to justify our advice. Okay, so let's talk about the original budgeted production plan. So we can see that we figured out a profit, right? So budgeted profit was a 15,177, and we can say that this will produce an optimum profit. Let's write it down. Will produce an optimum profit. Okay, then since we are cutting down the production of product Y, some regular customers may not receive their order, right? Let's write it down as well. Some regular customers may not receive their order. Okay, and let's talk about the alternative plan or the overtime option. So we can see that we figured out that there would be a loss if we followed up on this overtime plan. Let's write it down. Will result in loss on our additional units. But since we will be producing all of the regular amount of product Y, all regular customers will receive their order. So now we need to make a decision based on these factors. So if we follow up with the production plan, we can see that some regular customers may not receive their order, which means that those customers might move towards our competitors and seek their required products from them. And in the coming months as well, they could continue purchasing from our competitors rather than our business, right? So that is a major loss to our business. But if we follow up with our overtime option, we will have to bear some sort of loss, but this loss will be covered up by the profit that we will be able to achieve in June 2022. So in my opinion, the directors should use the alternative plan. Let's write it down clearly. The directors should use the alternative plan. Alright, this concludes the seventh part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.